Hi there, welcome back to my channel. In this particular video, we are coming to continue our discussion on the company valuation methods that we started in the previous video. In my previous video, we looked at a general introduction to company valuation techniques in financial modeling. We explained what enterprise value is. We also looked at what equity value is. We looked at multiples and how they are used to determine the value of a company. We also looked at a general overview of the three main valuation techniques, which include the discounted cash flow technique. We also looked at the comparable company analysis and the precedent transactions analysis, which is also known as past M&As. Alright, so at the end of that video, I made the promise that I'm going to start off with the discounted cash flow technique, and so that's what we are coming to look at in this particular video. If this is your first time on my channel, this is the Gen Z Analyst channel, and on this channel we deal with finance, accounting, data analytics using tools such as Excel, Power BI, and Python. So you can check out all those videos on my channel. You can go to the channel pages and check out those videos. And also in a playlist to this video, you would find a whole lot of financial modeling videos that you can learn to master the art and science of financial modeling. Alright, so let's get started in this particular video. So what I'm going to do first of all is to go to one of my old formats and copy one. So I'm going to copy the format of our debt schedule. So let's copy this and come back to my DCF sheet, and I'm going to the paste section here. I'll click the drop down there and select keep source columns with. So I'll keep that, and this is it. Now when it comes to the DCF modeling, we are not going to make use of the historical section here, so I can select the first one, press and hold shift, and also pick the last one there and hit delete. And because the historical years are referencing the forecast years are referencing the historical years, this is referring to a reference error. So all we have to do is to clicking on the first one, just input 2024 there, which is our first forecast period, and hit enter, and this will populate the other cells for me. Alright, then we'll also change the name of this to this is going to be discounted cash flow valuation model. Alright, so we would have that. And finally, I want to turn off the grid lines so that everything can be clearly seen. So I'll come to my view tab here, and then on the view tab I'll uncheck the grid lines there, and then this will turn off my grid lines. Alright, so in my last video I actually made an introduction to the discounted cash flow technique, and I mentioned that when it comes to the discounted cash flow technique as a business valuation method, we need to first of all establish the cash flows to value our business, and these cash flows are called unlevered. So let me type that. We have already looked at that in the previous video, which is the introduction. So we call it unlevered free cash flows. Alright, unlevered free cash flows. And what we do is that after we determine these unlevered free cash flows for each of our forecast periods, which in this case are 5 years from 2024 through 2028, we are going to discount these free cash flows at an appropriate discount rate. Alright, so we will discount these cash flows at an appropriate discount rate into their present values. to their present values. All right. Then, after we are done, we will estimate what we call the terminal value. This terminal value refers to the value of the business after the last forecast period, which is 2028. So after 2028, what is going to be the value of our business? That is what we call the terminal value. And this terminal value is estimated using multiples, all right? And we have looked at all of that in our previous video. And so after we determine our terminal value, we are going to discount this terminal value as well into its present value. So at the end of the day, what we will do is that we will sum the present value of our unlevered free cash flows and the present value of our terminal value to obtain our enterprise value, or the EV of the business, and that becomes the value of our business. All right, so in a nutshell, the discounted cash flow valuation model takes into account three variables. The first one is our unlevered free cash flows. The second variable is a terminal value, and the third variable is our discount rate. As soon as you're able to obtain these three key variables, then you can be able to perform a well-structured discounted cash flow technique. Okay, valuation analysis. All right. So with that said, let's look at the first one, which is the unlevered free cash flows. So in order to calculate the unlevered free cash flows, the name unlevered means it does not include interest. Okay, but in a sense, the unlevered free cash flows are referring to those cash flows that are available to all capital providers, including our equity shareholders and debt providers. All right, so it measures the cash flows before equity shareholders and lenders are paid. That means that this cash flow removes all cash flows relating to our capital structure. When you talk about the capital structure, you are talking about the financing structure of the business, and that usually comprises equity and debt. Okay, so when you are talking about that, we essentially mean these cash flows are going to exclude dividend payments, interest on debt, any payment to non-controlling interest, and others. All right. And it also eliminates all non-recurring and extraordinary items such as our business acquisitions, purchases and sales of marketable securities, and proceeds from the sale of PP&E, that is property, plant, and equipment, and considers only day-to-day transactions. For instance, capex or regular transactions, which is capex and the rest like that. All right. So basically, to be able to calculate the unlevered free cash flow, we are saying that you need all cash flows that are not affected by your financing structure or your capital structure. And it also involves the use of your cash flows that are from operations. All right. Remember, we are talking about calculating, we are going to use this to calculate our enterprise value. And enterprise value essentially includes the value of the business that is generated from our operating assets. All right, so take note of that. And because of this, to calculate our unlevered free cash flows, we start with EBIT. Now, EBIT is earnings before interest and tax. So as you can see, this line item comes before our interest and before any dividend payments to preference shareholders and all that. All right, so that is what we are having there. Okay, so we start with our EBIT, and what we are going to do is to less cash taxes. Cash taxes. The next item, you are going to list all of these, and then we will see how to obtain these figures from our financial model. So when we take our EBIT and less our cash taxes, we will get what we call NOPAT. NOPAT is our net operating profit after tax. Now remember, this EBIT is also called operating profit, right? So when you deduct your cash taxes or taxes from your operating profit, then you will get what we call the net operating profit after tax. All right, then after that, we are going to have we are going to add some non-cash items, and these non-cash items are all operating activities. So popular among them includes depreciation. Remember, we are dealing with Amazon financial statements, and so we are going to be going according to the line items within the Amazon financial statement. So the first one is depreciation and amortization. The second one is going to be stock-based compensation. The next one, from our analysis of Amazon's financial statement, is going to be deferred taxes. And then the last one is operating or other operating expenses. Now, this is very simple. If you pick any financial statement, go to the cash flow statement within the cash flow statement of Amazon. And when you look at the cash flow statement, the cash flow statement has operating activities. So when you look at the operating activities, you will see our non-cash items. These include depreciation and amortization, as you can see here. We have stock-based compensation, as you can see here. And then we also have other operating expenses, as well as deferred income taxes. All right. So these are the items we are dealing with. And then you also see changes in operating assets and liabilities. All right. And we are going to deal with that also. So those are the items we are dealing with. And we are saying that these are relating to our operations and to the earnings of our business, to be able to know how much we are generating from our operating activities in cash. Remember, this is cash. All right. And so since these items are all non-cash items, we need to add them back to our earnings before interest and tax. So that is the technique we are applying here. So let's increase the indent here to match with that of depreciation and amortization there. All right, so we can leave it like that. Then when we do this, then we are going to get a figure called EBITDA. After that, then we are going to have capex, and we are going to less the capex. So you less capex, which is our capital expenditures. So these are assets we have bought for the business, and so the money we have used to purchase these assets need to be taken out from this cash available. Remember, we are calculating the cash that is available to be paid to both equity and debt holders in the business, right? So that is that. And then we will make an adjustment for net working capital. Net working capital. So we are going to add, for the add, this is not a rot something you need to learn. The add here is actually dependent on how you present your net working capital, okay, within the financial statement. And when we get there, I'll explain it further, because others might use less with net working capital. Okay, so we'll look at that. Then after that, you will have your unlevered free cash flows. Okay, so now that we have gotten the format of the unlevered free cash flows, let me actually put UFCF here. All right. Now that we have gotten our the format, let's input the figures now. So the EBIT, as we already know, can be found from within the income statement. So when you come to the income statement and you scroll down, you can have our EBIT. which is earnings before interest, and that is here. Remember, we are picking only the forecast periods, so I'll pick this of that of 2024 here. All right, so let me go back and input my sign. So I'm going to have equals and income statement here, and pick my EBIT for 2024 and hit enter. Then, now when it comes to the cash taxes, you need to be very careful. The taxes we are talking about here is not the income statement tax. All right, because the income statement tax was calculated on earnings before tax, which is EBT, as you can see here. But we are talking about earnings that does into account interest. As you can see, before we got our EBT, we had already adjusted for our interest expenses and interest income. All right, so we need to just grab income tax rate and apply it on our EBIT and not our EBT. All right, so never make the mistake of picking the income tax amount from the income statement. All right, so our income tax rate here is 22%. So quickly, I'll come to this place and I'm going to have my EBIT multiplied by 0.22 and hit enter. And I can format with a comma separator with 0. Let me select the entire place here and do that. So comma with 0 decimal places right there. Okay, now let's put brackets here. The financial model should always contain as much detail as possible, and it should be presented very clearly. And so I'm going to have at 22%, close my parentheses. Okay, so our NOPAT, and this is negative figure right there. So as you can see, all the items I am considering as an expense, or they are having a negative effect on our cash, are going to be in brackets. And that is why I'm putting my add net working capital here, because I'm going to put it in brackets. Okay, that's why I have where as a positive number, then I can put here less. All right, so that I will less it from there. When you get there, you understand it even more. So we'll have this, and let me input my border there. So our NOPAT is going to be the addition of these two figures. So this is selecting our 2024 figure there as well. So I'm going to use the down arrow key to select this, and holding my shift, I can use the top arrow to select the second figure there and enter. So our NOPAT is 31,529. Now we have our, now after this, all of the other items are going to come from the cash flow statement. It is only the EBIT that income statement. The other items are all coming from the cash flow statement. So let's go and pick our depreciation and amortization amount from the cash flow statement. So I'll have equals, come to my cash flow statement and locate my depreciation and amortization amounts there, which is this right here. I'll enter, pick that of stock-based compensation and hit enter, pick that of my deferred taxes and hit enter. Now this is presented as a negative, so quickly we need to put another negative sign here and hit enter to convert it into a positive. Then I'll pick my operating expenses. Now the operating expenses are both negative and positive, so we'll pick it like that. So we have other operating expenses or income. So I'll hit this and that. Okay. Then we have our EBITDA. So the EBITDA is going to be alt equals including. So again, press and hold shift and use the top arrow to select all of the figures there up to NOPAT and hit enter. So that is our total EBITDA there. Okay, so next we are going to pick our capex, and that is also from within the and come to the investing activities section or category, and the capex is the first item you can see here. So I'll hit enter right there. Okay, then we also have our net working capital. So let's come here with the net working capital. Let's come to it. We do not have a line item called net working capital, but we do have changes in operating assets and liabilities, and these are our net our working capitals. So when you add all of the changes, these are the changes. All right, as you can see from the formula bar here, this is the change from the previous period, right? And so when you add all the changes together, that is what is giving you net changes in working capital. All right, so let's go to DCF, and I'm going to have equals sum. Okay, and then what I'm going to do is to come to statement and add all my working changes in working capital together, close my parentheses, and hit enter. So this is the change in net working capital. So this is net changes in working capital, and put this as a negative. All right, then with this we can now find our unlevered free cash flow. So I'll just hit alt equals and use my down arrow key first to select the first item from the bottom, hold shift and use my top arrow to select the rest of the items there and hit enter. So this is our unlevered free cash flows for the first year of our forecast period, which is 2024. So let me insert some borders there. So I'm going to insert a top and double bottom right there. And then I can hold shift with the down arrow and select everything here. Still holding shift, I'll use my right arrow to select the entire space here and use Ctrl R to copy the formula to the right. All right, so we have dash for deferred tax. That shouldn't be so. So let's go to our cash flow statement and see what is happening there. Our deferred taxes. So let's come to the DCF and correct that. So I can have this. So this is referencing J15. So let's come to the cash flow statements. Okay. All right. So I think I know where the problem is coming from. So let's come back and redo that. So with the deferred taxes, I'm going to have equals minus. I'm going to flip the sign there. Come back to the cash flow statement and pick the figure from here and hit enter. And then I can copy this now to the right using Ctrl R. Okay, so these are our unlevered cash flows. Now that we have obtained these cash flows, we need to find an appropriate discount rate which we can use to discount these cash flows to their present value. All right, so that leads us to the second variable, which is our appropriate discount factor. So I'm going to leave a couple of space here, come down here and have our discount determination of discount factor. Now from our introductory video, discount rate, or it is also called cost of capital, discount rate or cost of capital. All right. So I'll hit there, and let me bold it this using Control B. Now, in my previous video, you will recall that I mentioned that when it comes to the cost of capital, we use the weighted average cost of capital. This is because this is a business that is financed by both equity and debt holders. All right, so we need to find an appropriate cost of capital that is acceptable to both let me say stakeholders or shareholders. So both the shareholders and the debt holders in the business or the debt providers. All right. So that is why we need to calculate a weighted average cost of capital. All right. So that we consider both our cost of equity, okay, which is for our equity shareholders, and then we also consider the cost of finance, which is for our debt providers. All right, so that is why we calculate our WACC. So because of that, the WACC is calculated as our market value. We pick our market value of equity. Now we have looked at all of these terms in the introductory video, and so when I'm mentioning them, it shouldn't be new to you. All right, so just that. So we have our market value of equity divided by the total number or the sum of our total capital for the business. When we talk about capital, we are talking about both equity and debt. So we are going to add or sum our total sources of capital. In this case, we are considering just equity and debt. So we are going to have a market value of equity again plus the market value of our debt. I'll close my parentheses and multiply this by the cost of equity, which we usually denote in finance as KE, like that. All right. Then we are going to add that of our debt as well. So we'll have the market value of our debt divided by the sum of this. So I can copy this and I can paste it here. Remember, I'm doing this for understanding purposes. So I'll multiply that by the cost of debt, which is denoted also as KD, as you can see there. But this cost of debt is going to be the after-tax cost of debt, and after-tax cost of debt is KD bracket open 1 minus our tax rate. All right. So this is actually multiplication as well. So that is how we calculate our weighted average cost of capital. When we get into the practice, you get to understand it. So in order to calculate the WACC, which is the cost of capital, which we are going to use as our discount rate, we need to find all of these formula. So we need to find the market value of our equity, which is the current market value of equity. We need to find the market value of our debt, which is the current market value of debt. We need to find our cost of equity. We need our cost of debt. All right, so that's what we're coming to do now. So down here, I'm going to have WACC calculations. All right, and then we are going to have our cost of equity. We'll have our cost of debt. We'll have the market value of debt as well as the market value of equity. All right. Okay, so we have that. Now, in order to calculate the market value of equity, we need the price per share of our equity and the total number of shares outstanding in the business. All right, so quickly we can insert and insert those variables. So in order to calculate our cost of equity, we need our price, our share price, which is our current share price, and the total number of shares outstanding. Okay, so we are going to kind of insert, let's select everything here and insert some borders around it. So let me select this round border here, and then here is going to contain our values. So that one there, and I can insert another one here. Okay, put this and also reduce the size of this a little. Good. So with that, we can have our WACC at the bottom here. So I have my WACC here. Also insert a border here. All right. So let me bold this using Control B as well. All right. So we can now determine the values of this. Now, when it comes to the cost of equity, which is the first one here, the cost of equity determination is also a complex one, and we have various ways of determining our cost of equity. We have what we call the CAPM. Okay, CAPM. So we have CAPM, which is called CAPM model for determining the cost of equity. And then we also have the Gordon's growth model, Gordon's dividend growth model. All right, these are all ways of determining our cost of equity. But for the purpose of our video, we are going to rely on the CAPM because it's more simple and widely used. All right, so we are going to depend on that. So we can have here our costs of equity using CAPM. So I can delete this and also delete this. Okay, so when it comes to the CAPM also has a formula. So let me put my CAPM formula here as well. So CAPM is equal to, we have risk-free rate of return plus we have beta multiplied by the market risk premium. All right, so that is the CAPM formula as well. Now, it means that if we want to calculate the cost of equity, we need to find all of these variables, just as we did for our WACC. So we need to find all of these variables. And so in order to do that, we are going to do the same thing here. So I'll have my risk-free rate of return I'll also have my beta. I'll also have my market risk premium. And this should give me my equity costs of equity. All right. So yeah, let's insert some borders here as well. I'm going to insert, and the cost of equity, I can cut it. Okay, let me copy it rather and paste here, and then I can delete this one. My border has been erased, so let me insert. All right, then this place is going to contain the values for our calculation. So let's insert another border there outside. Okay, so now that we are done setting up everything, let's start inserting our formulas. Now all of these values or all of these variables within a CAPM formula can be found online. So with a risk-free rate of return, we can actually find that from the US Treasury Department. Now, let me explain the CAPM formula. We are saying that this is measuring our cost of equity. Now, the cost of equity from the CAPM formula is going to consist of, now we know that equity carries risk. All right, when you buy equity in a particular business, it's going to come with at a risk. So you are saying that when you buy equity, the cost of that equity is going to include the risk-free rate of return on any equity, which usually we take the government treasury bill as a benchmark for or determine free rate of return. So we mostly in finance we categorize government treasury bills as risk-free securities. All right, and so the return on those government treasury bills are what we are calling risk-free rate of return. Also, so we are going to pick that particular risk-free rate of return and add it to the beta of our shares. Now, the beta of a particular share or stock is um, talking about how the price of that particular stock responds to changes in the market. All right. So when you have a beta of 1.0, when a company's stock has a beta of 1.0, it means that if the market prices change by 1%, this company's share price will also change by 1%. All right. But where it is 1.5, then where um, the share prices on the market changes by 10%, the share price of a particular company whose beta is 1.5 is going to change by 15% as follows. All right, so that is how the beta also works. So it determines the how the share price of a particular company changes with regards to changes in the market. All right, so that is our beta. Okay. So with the beta, then we have our market risk premium. So the risk premium is talking about the extra return you are earning on top of the risk-free rate of return as a result of the risk you are bearing by purchasing or investing in that particular share or stock. All right, that is the market risk premium. It is the extra return you um, get or expect because of the risk you are bearing by investing in a particular stock or shares. All right, so that is how the CAPM formula works. And so when it comes to determining the risk-free rate of return, you can get that from the US, since Amazon is a US domiciled company, although it is also having other branches or operations all over the world. It is chiefly domiciled in the US, and so we can use the US Treasury bill to be able to do that. Now, when I checked on the US Treasury bill, when I checked the risk-free rate of return or the risk-free rate on US Treasuries from the US Department of Treasury, I have obtained 4.0. 4.0%. So what I'm going to do is format this as a percentage, my 4.0 there. All right, so this to 1 decimal. Now the beta can also be determined from finance.yahoo.com. All right, so when you go to finance.yahoo.com, you should be able to locate the beta of Amazon. So you can just Google beta of Amazon and then you go to finance.com to get that. When I researched, I got 1.15. So this is the beta Amazon 1.15, which means that where the prices on the market is changing by 10%, that of Amazon is going to change by 11.5%. All right, that is not bad at all. It means that it doesn't respond aggressively to changes in the market. Then you have the market risk premium. The market risk premium is the return in addition to your risk-free rate of return. And so from my checks, you can also search again. Just Google market risk premium. You will see a lot of sites, a market risk premium of Amazon stock or S&P 500. All right, S&P 500, and you'll be able to get information from there. And from what I have researched, I got 4.33%. Okay, so let me delete this again. Format it as a with 1 decimal 4.3 here. Okay, so with this information, I can now calculate my cost of equity. So the cost of equity is going to be equal to my risk-free rate of return plus the beta multiplied by my market risk premium. And I'm going to hit enter. Okay, so the cost of equity is 8.9. Let me reduce this. So that is 8.9%. All right. So we have determined our cost of equity, and so I can quickly put that here. So I can reference that from this place and hit enter. Okay, now the cost of debt. The cost of debt can be found from within the 10K of Amazon. So when it comes to the 10K of Amazon, which I already did, this table we have already seen it when we were constructing the debt schedule. Now when you come to the 10K, you will see some effective interest rate on our debts. So the last one here is December 2022 note issuance of 8.3 billion, and this comes at an interest rate ranging from 4.61% to 4.83%. We want to be conservative enough, and so we are going to pick the 4.8% here. So let's come back to our model and hard code 4.83%. Let me and input 4.8 right there. Increase it to 1 decimal place. All right, so we are done with the costs. Now we come to the market values of our debt. So the market value of our debt is going to be equal to, we can find that from our cash flow statement, the balance sheet, or we can also find it from the debt schedule. So let's go to the debt schedule rather and pick it from there. Unfortunately, on the debt schedule, we only have our historical years. So let's go to the balance sheet and pick it from there. All right. So this is going to be our total debt for 2023, which is the last year. Remember the values. Okay, so this is going to include our long-term lease liabilities plus our long-term debt from here, and we are going to add our short-term debt, and that can be found from the debt liabilities here. So this is 2023, which is 8494. we obtain this figure from the 10K of the Amazon financial statement. Okay, so with that, I can hit enter. So this is our total debt. Let me insert my comma separator. I want this to 0. Okay, now what is the share price of Amazon? As of 1:08 p.m. this today, 6th February 2025, the share price of Amazon was 237.80. That was the share price of Amazon, $237.80. All right. Now the total number of shares can actually be found on our income statement. So and pick that the last year, which we are going to use the diluted number of shares, right, which is 10,492 here. So I'm going to pick that and hit enter. So that is our total number of shares as well. To get the market value of our equity, we multiply these two together. So that's going to be the share price multiplied by the total number of shares outstanding. So I'll hit enter. Insert my comments. All right. So I have that. Now that we have gotten all of these values, we can now calculate our WACC. So the WACC is going to be equal to as you can see from the very top here, is going to be the market value of our equity divided by, I'll open my parentheses, market value of equity again, plus the market value of our debt. I'll close my parentheses and multiply this by the cost of equity, which is 8. And I'll add the market value of our divided by, open brackets, the addition of the market value again plus the market value of our debt, close the parentheses, and multiply this by the cost of our debt, which is 4.8. But remember, this is going to be after tax cost of debt. Remember, there is a tax shield whenever you go for any debt. That is why we are taking the after tax cost of debt. Okay, so I'm going to have a bracket open here, 1 minus our tax rate, which is 0.22. I'll close my parentheses and hit enter. Okay, so we can correct this reference error. I think there was a mistake here. So this is the cost of debt, and then we have to multiply it by 1 minus. So let me put my multiplication here and hit enter. So this is giving us 8.6%. So this is our WACC. All right. So now that we have gotten our discount rate, we can now go back to our unlevered free cash flows and do the discounting. Now, in order to discount, we need the discount period. So we're going to have discount period. The discount, when we want to discount any future cash flows into the present value, we need a period within which to discount. Now, this period is talking about when we are expecting these cash flows to be realized. All right, so it can be a mid-year discounting period or an end-of-year discounting period. Now, we want to keep our assumptions within our model very simple, and so we are going to assume that these cash flows are going to occur at the end of each year. So we are going to have a whole year discounting. So I'm going to have 1 year, which is period 1, period 2, like that, and then I can copy this. Sorry. So let me select these 2 items, and I can use the autofill to fill that to the right. All right, up to the 5th year. So we have our discount period. Now that we have our discount period, we can calculate what we call the discount factor. All right, now the discount factor is calculated by a formula. The formula for our discount factor is, let me put it in brackets, is going to be 1 plus our discount rate, which is denoted as lowercase r, and I'll close this, and this is going to be raised to the power n, which is the number of periods, okay, which is the discount period we have put at the top here. So that is the formula we use when we are calculating or determining our discount factor. The discount factor is also going to apply to the cash flows in order to obtain their present value. Now remember, all of this you are doing can actually be done using Excel formulas, all right? But it is always good to understand the brain behind the numbers so that you know exactly what you are doing. All right, so we are going to have that. So I'm going to have equals 1 plus R. Our R is the WACC we have calculated, which is 8.6 here. So I'll reference that. And this will be in brackets. So I'm going to put this in brackets. Raised to the power our period, which is 1 here. And so this should be 1 divided by that. So hit enter. And so I can format this to copy this to the right using Control R. So this should actually be this. I'll hit enter. Okay, so what I will do again, formula is not working properly. So this WACC or discount rate has to be anchored. All right, so I'll use F4 to anchor that so that it does not change as we copy the formula across. So I can now copy this across using Control R. So now we have our discount factors as well. So with the discount factor now determined, we can calculate the present value of the unlevered free cash flows. All right, and that is equal to our future cash flows multiplied by the discount factor. All right, I can format this to 0 decimal places and copy the formula across using Control R. So these are the present values of our unlevered future cash flow. All right, so we are done with the first part. Now it's left with the second part, which is the determining our terminal value. All right, so the idea behind the terminal value actually is that now that we have projected our future performance, which is these cash flows here, the unlevered free cash flows we are seeing here, what is going to be the value of the business after this projected period, 5-year period? All right, that is the question that the terminal value comes in to solve or to answer. So the terminal value estimates the value of the business after the last estimated year, which is 2028. After 2028, what's going to be the value of our business? All right, that is what the terminal value comes to solve. Now, the terminal value can be solved or can be determined using 2 methods. We have the multiple method and the perpetuity method. These are the 2 common methods for determining the terminal value. All right, and this is very important. All right. Okay, so the first one we want to look at is the multiple method. Now, under the multiple method of calculating the terminal value, a multiple is applied to the last year's projected figure. Usually, an EBITDA multiple, which is the EBITDA, is applied to the company's final year EBITDA, the assumption is that the value of the company in the last year is the sale value in that particular year. So if you have an EBITDA multiple of say 10 times, okay, so you have an EBITDA multiple of 10 times, what this means is that if the cash flow of the company for the last forecast period is say 500,000, what we are saying is that the value of the business for which you are going to sell it is going to be this 10 times the 500,000 here, which is going to give us 5 million. All right, that is going to be the cost or the value of the business in case you want to sell the business in that particular period. All right, so that is the idea behind the multiple method. So the multiple method can be a comparable companies. Okay, now the multiple can be a comparable companies or the company's own current market multiple. So we are saying that in order to calculate our terminal value, we need to find our exit EBITDA. After finding the exit EBITDA, then we'll find our EBITDA multiple. After finding the EBITDA multiple, then we can now find our terminal value. After finding the terminal value, then we can find the net present value of the terminal value. Okay, so let's get started. Still, I'm going to insert my usual borders. So outside borders, and also this outside borders. Okay, so the exit EBITDA, as we have already explained, is equal to the EBITDA for the last forecast period. All right, so I'm going to have equals. Now, for the purpose of calculating this EBITDA, we are not going to pick this particular. This is technically not EBITDA, okay, but just for understanding purposes, that's why you put it there. Technically, EBITDA is our EBIT, so I'm going to pick that of 2028 EBIT plus our depreciation and amortization, because EBITDA is actually earnings before interest, tax, depreciation, and amortization. All right, so I'm going to pick those two figures and hit enter. So that is actually our EBITDA. And in order to avoid any confusion, let me actually remove this particular description from here. All right. So that is our exit EBITDA right there. Now we have to calculate the EBITDA multiple. Now the EBITDA multiple, as we have already learned in the previous video, is equal to our enterprise value divided by our EBITDA for 2023, which is the last historical period. Okay, so EBITDA or EBITDA multiple is equal to AV divided by the 2023 EBITDA. That is the formula we are going to use. Now we don't know our enterprise value. So our enterprise value, the market capitalization, and we have already calculated our market capitalization, which is the same as the market value of equity, which is this. Okay, and then we are going to add the market value of our debt as well. And I'm going to subtract my cash and cash equivalents. We have did this in our previous view. So let's pick our cash and cash equivalents, 23 figure as well from here. And then I'm going to hit enter. Now this divided by our EBITDA for 2023. For 2023, so let's go to the income statement and pick our EBITDA for 2023. So this is our EBITDA for 2023 right this here. So I'm going to select that and hit enter. So actually, let me try and put this in brackets and see what that is going to give me. So this is giving us 30 times. All right. As we already know, multiples are written in times. So in order to bring the times there, you can just hit Control 1, come to Control 1, come to Custom, and under Custom, scroll up and then select this 0 from here, and with the 0, bring quotes and times or X, close your quotes and hit enter. This will add the times to that particular multiple for us. So this is 30 times. All right. Okay. Now the terminal value is going to be equal to this, our exit EBITDA multiplied by our EBITDA multiple. So that is giving us this particular amount. I'm going to format it to 0 decimal places. And we can find the net present value of the terminal value, which is actually the present value of the terminal value. So this should be equal to our terminal value divided by bracket open 1 plus our WACC, our weighted average cost of capital, close my parentheses, and raise that to the power 5. Raise to the power 5, which is the last from here. So I'll enter that and reduce it to 0 decimal places. All right, so that is giving us 1,500. Okay, present values. So now we have the present values of our unlevered free cash flows for the 5-year period. We have also determined the NPV of our terminal value. So with this, we can calculate the enterprise value of our business of Amazon. Right? Remember, we are trying to value Amazon stocks. All right. So let me quickly cut this again and put it back to its original place. So Control X, select here, and Control V to paste right from there. All right. So let us insert a couple of rows here. Under the multiple method first, and then we can go ahead and do that of the perpetuity method as well. All right. So this is what we are going to have. We'll have enterprise value. Now to calculate the enterprise value, we will have the NPV or net present value of the unlevered free cash flows. We also need the NPV of the terminal value. Okay, and that is going to give us the total enterprise or enterprise value, just enterprise value. All right. So let me have total value of the firm. Let me bolding that. Okay, so we have that, and then I can also bolding this as well. Okay, so we now have the value of our, then this is multiple method, and we are going to have the perpetuity method here. Okay, we already have the total value of our unlevered free cash flows. Now the NPV of it is going to be the sum of all of the present values of our cash flows. So I'm going to select from here. So sum of all of this, close my parenthesis and hit enter. Then that of the terminal value is already determined for us up top here. And then I can sum this together. So alt equals to sum all of that and hit enter. So that is the total value of, or that is the total or the enterprise value of Amazon per the assumptions we have made in this particular in building our financial models. All right, so I can bold in that as well. Okay, now we need to determine the equity value also. So the equity value, as we already know, is a portion of the enterprise value. So in order to determine our equity value, we need to subtract the net debt. So we have less net debt. And we already know the formula for calculating our net debt. So the net debt is going to be equal to our total debt, which we have already, our total debt, which is the market value of our debt from here, minus the cash and cash equivalents, which you can find from our balance sheet, and pick my cash and cash equivalent from for the last period, which is 2023, and hit enter. So that is that. So with this, I can now have my equity value of the business or of Amazon. So the equity value is going to be my enterprise value minus the net debt. I'll hit enter there. So this becomes our equity value as well. Then we can find the price per share, our price per share. So in order to calculate the price per share, we need the total number of shares outstanding. So I can have my number of shares outstanding, and I already have that beneath here. So I have my total number of shares outstanding right from here, and remember this is also in millions. Okay, so this will be equal to, so we'll have our price per share, and that will be equal to our equity value divided by the number of shares outstanding. Okay, that is 158. So we could see that this is giving us a very low amount as compared to the market value, the current market value of Amazon. All right, it's because of the assumptions you have made. Now, the assumptions you have made were conservative, very conservative. So that this is where you can bring in the issue of scenario and sensitivity analysis. All right, you can check out my other videos on discounted cash flow technique, where I actually employed those sensitivity and scenario situations into the model for us to see how the price is going to change if conditions change. All right, so that is that. You can as well look at the aggressive side of the model or the base side or the conservative side as you are doing in this particular situation. So this is actually expected. All right, this is actually expected. So that is the value of Amazon using the multiple method, which is EBITDA multiple. All right. Now let's look at the perpetuity method. So the perpetuity method, it is dependent or it is based on a typical perpetuity. Now when we talk about perpetuity, we are talking about constant cash flows into infinity. All right, constant cash flows into infinity. So you are receiving cash flows forever. That is perpetuity. So this method is saying that we are going to be receiving a constant amount of cash flows in infinity. Okay. All right. Now, under the perpetuity method, the terminal value is equal to, we calculate the terminal value based on formula, formula. Okay. And the formula is, so we have terminal value. I can just make it TM is equal to the unlevered free cash flows multiplied by, I'll open bracket 1 plus a growth rate, I'll close my parenthesis and divide it by, I'll open another bracket, my discount rate minus this growth rate. I'm going to explain this particular formula for you. So we are saying that under the perpetuity, we use this particular formula to calculate the terminal value. All right. So unlike the multiple method that is based on a particular multiple, which is, for instance, the EBITDA multiple, we under the perpetuity method, we make use of this particular formula here. All right. Now, the G is the perpetual growth rate of our cash flows. The G within the formula is the perpetual growth rate of the constant cash flows you are going to be receiving. And the R, as I already indicated, is the WACC or the discount rate. Okay. So let's see how that is going to play out. So the first item you're going to have is our unlevered free cash flow. I can actually come here and do it here. So I'll have my perpetuity method. All right. So the first item we're going to make use of is our unlevered free cash flows for the last period. Remember, this is actually talking about the exit value, which is the terminal value. Okay. So you are going to pick, this is going to be equal to the, which is 2028. So I'll pick this particular value here and hit enter. And hit enter. All right. Then we'll have our growth rate. Remember, we are only using the variables within the formula to do this. All right. So this will be equal to, for the growth rate, it is an assumption we are making. And when making this assumption, you need to consider the life cycle of the particular business you are dealing with. If it is an emerging business, then you can use a growth rate that is very high or quite high, not very high. Okay. So typically for matured businesses like Amazon, we can use a rate between 1 to 4%. It shouldn't be more than 4%. All right. But for other businesses that are fast growing, we can use some 5 or 6%. All right. So we are going to use 3% for this particular PEP right there. So let me increase it to 1 decimal. The last variable within the perpetuity form, cut this, come to the top here, and paste here. All right. So the next item we need to also look at is our WACC, which we already have. All right. So we can now have our terminal value. And the terminal value is going to be equal to, with the formula, it is our unlevered free cash flow multiplied by, I'll open my bracket, 1 plus my growth rate, close my bracket, divided by my WACC to get from here 8.6 minus the growth rate of 3. So I can put this also in brackets and hit enter. So this becomes the terminal value under the perpetuity method. So with this, I can actually find the net present value of the terminal value. And that is going to be equal to my terminal value divided by 1 plus the WACC once again, and I'll close the parentheses, raised to the power the last period, discount period, which is 5 years. Okay, and hit enter. And reduce the number of decimals to 0 right there. Okay, so quickly, let me put all of this in brackets, and this alone also in brackets. So that is the perpetuity method. We pick this particular formula and fill in the variables. Okay, so the unlevered free cash flow for the last year period, we estimate a growth rate, and then we can use these two methods together with our WACC or the discount factor to estimate the terminal value. Okay, and then we discount terminal value into the present. Now that we have gotten that, we can fill in this particular part as well. So we are going to have our net present value going to be the same as this, so I can copy this to the right using Ctrl R. Then the terminal value is going to be equal to our terminal value under the perpetuity method. Then we can sum those together, so I can copy the formula here to the right using Ctrl R. Then for my net debt is going to remain the same, I can copy it to the right. Then for my equity value is going to be this, using to the right. Okay, so what I will do is to, because I'm copying it to the right, it has copied a different figure. So what I'll do is to anchor these values. So I'll use F4 to anchor this, and also anchor the balance sheet reference. And then I can copy this to the right. Okay. Our number of shares is going to remain the same, so I can copy it to the right. Also using F4 and copy it to the right. And then I can copy this formula also to the right using Ctrl R. So you could see that the share price, or the price per share, the value of the business under the multiples method and the perpetuity method are very different. Now, this is very significant because whereas the perpetuity method is based on cash flow projections and some low growth rate assumption, the multiple method is largely market driven. So you could see that before we could do that of the multiples, we need to find all of these items which are market driven. So let me delete this extra space. It is therefore recommended to run the two methods always and compare the resulting terminal values. Now, if you do that and the multiple method, the value you have obtained under the multiple method is much higher than the perpetuity method, then which we have in this particular scenario, then maybe the markets are overvalued, or maybe the cash flow projections are too low. All right, which I have already explained that we have used the conservative approach in this particular model, and so you could have a bit of these distinctions. All right, or if the multiple method is much lower than the perpetuity method, then perhaps our cash flows projections are overly aggressive, or perhaps the markets are undervaluing the business. Okay, so the best case scenario is to see both methods returning similar terminal values, implying that the cash flow projections are in line with market expectations. So in this particular scenario, we can say that the markets are overvaluing this particular business, which is Amazon, or our cash flow projections are too low. All right, so that is the cause of the difference between the multiple method and the perpetuity method we are seeing here. All right, so that brings us to the end of the DCF method of valuing the projections, and the valuation we just undertake were all dependent on market values, but on our financial model. Intrinsic valuation method. Okay, so in my next video, you can comparable company analysis method of business valuation. So stay tuned to my channel. If you have not subscribed to the channel already, please make sure you are subscribed to the channel, and don't forget to share the video with others so they can also benefit. And don't also forget to hit the like button if you found this particular video useful. All right, so I'll see you in my next video.